TJX full-year same-store sales growth forecast came in weaker than expected, making it the latest retailer, along with Walmart and Home Depot, to express caution in its forecast for the year ahead. Retail earnings roll on next week, too. We'll get results from the likes of Target, Abercrombie Fitch, Foot Locker as well, and more. Here to discuss is Stacey Widlitz, SW Retail Advisors President. Stacey, great to have you here with us. So first, want to get your reaction to TJX's earnings this morning.
Very strong mid-single digit comp numbers here. And really what you need to focus on is transactions are up. This is not a ticket story. This is a traffic story. This is a story where the consumer is getting, hit every way with inflation, yet incredible treasure hunt and value, one of our very long-term top picks, and continue to like the stock here. Yes, like Walmart, TJX was a little bit conservative on their guidance. I mean, this is quite normal for Walmart and TJX to approach a new year conservatively, particularly since there's so many moving parts in our economy right now, and with the administration, with tariffs and what ifs. So I think it's more about just being conservative than actually what's going on right now. Walmart has said their consumer is very steady right now.
And so those are some of the themes that could certainly kind of transpire through some of the other big names in retail. I want to run through some of your takes on some of those big names. Abercrombie Fitch, for instance, that's off to a rough start this year after rising nearly 70% in 2024. How are you evaluating the growth and how that translates into the share price appreciation from here?
Yes, we've seen a group of brands come out on the other side of COVID and really keep full price selling intact. And investors have looked at this group of stocks, Ralph Lauren, Tapestry, Abercrombie, and said, is it sustainable, or are they going to go back to discounting someday? Tapestry and Ralph Lauren have shown us, yes, overwhelmingly, this is sustainable. Both of them had double-digit average selling prices up last quarter, and the consumer was out there buying. Abercrombie, that's reporting next week, they've shown a couple promotions on the Abercrombie brand in the last couple months. So that's a big question mark here. And the stock has traded off significantly because we've seen some of those promotions hit the market that would suggest maybe their full price selling is not as intact as other brands.
Next here, as we're talking about some of the brands, let's talk about Nike. Big turnaround plan underway here, new CEO at the helm. So how are you looking through this brand and your assessment there?
Yeah, I think, Nike, first of all, has a ton of newness in the market right now in footwear, which is great. But I think also, Nike has cut back. They have kind of alienated some of their core runners. They're trying to get that back. It's a big ship, and it's going to be a big task to turn it. You've seen on running, you've seen Hoka take nice share from Nike, and they may be able to get it back, but I think right now I'm still conservative on the stock. We've been negative on the stock for close to a year and a half, and I would say that there's still some flags in the market. The percentage of apparel on discount is up year over year. Footwear is like, there are green shoots in footwear, absolutely, but I'm still a wait and see on that one.
You mentioned Hoka. Let's talk about their parent company, Deckers, here. So how is the market share gains there sustainable in terms of the growth that we've seen come forward for the brand?
I think it is. You've got the Uggs brand, obviously, which has accelerated over the past year and has been performing incredibly well. And of course, you have Hoka, which has been growing heavy double digits for years. And investors have been looking at the stock saying, again, when is it going to slow down? Can this last? And yes, their numbers did decelerate a bit this quarter, and their guide was somewhat conservative, but they have new launches in the market that are being received incredibly well. And I think that brand absolutely has staying power and will continue to grow here and will continue to take share. So, the stock has come down nicely on some very conservative guidance. So I would take a look absolutely at that stock. You've got two incredibly powerful brands that continue to perform and continue to launch new drops that are being received very well.
Well, let's talk about a company that hopes all of the newness is positive, and that's Foot Locker. They report earnings next Wednesday. Is this a stock you like?
No, again, we're avoiding Foot Locker. And if you think about it, Foot Locker is over 60% exposed to Nike. So if you want to play Nike, play Nike. Foot Locker is obviously the middleman. And again, They've had a lot of apparel on discount. It's been up year over year. They are benefiting a little bit this month from some of the new drops, which is great. But I think there are better places to look for investing at this point.
Lastly here, while we have you, we got to talk about the name that is within a 10-mile radius of 90% of America, and that's Walmart. Their latest guidance came in a bit conservative. Do you see headwinds ahead for the company, especially as they have several different aisles and categories that they're trying to maintain across for consumers' mindshare?
You know, Walmart's numbers were very strong. They did a 4 comp on top of over a 4 comp last year. The traffic is still positive and the ticket is positive. And if you think about this environment, again, inflation, it's not transitory, it's not going away. It's reaccelerating a bit in food. If you think about it, they are the best positioned in the market to go back to their vendors and say, you know, give us a break. We want to pass it on to the customer. We're not raising prices. And they win at that. You know, also don't forget they were positive in every category, even general merchandise, even though there was some deflation there. And of course, they have all these other higher operating margin revenue streams like advertising and marketplace that are just getting started. And finally, they are not the old Walmart. They are the new Walmart, where the higher income consumer is the majority of their comp growth, because those customers are now looking for value, whether it's food or health and wellness, and they are gaining that share. And I think that is not going to change anytime soon. So I'm a huge fan of Walmart here. Yeah,
Walmart CFO John David Rainey has joined us on the program before, talking about those higher end consumers trading in to Walmart. Stacey, thanks so much for your evaluation, this roundup of retail that we've been able to run through. Appreciate it.